Hello there, everyone. This is Bruce at Fleet Capital Management. It's Friday afternoon, July 17, 2026. Not a good day in the market, but not a bad day for us with these redesigned portfolios. And that's what I'm going to show you on today's video. We always start by saying that the video presentation is intended for educational purposes only. The discussion of any security is not a recommendation to purchase or sell the security. You know I'm always available. Bruce at Fleet Capital Management. So I'd like to talk about Group 2 portfolio because the vast majority have chosen Group 2 portfolio. Next week, I'll talk about 1 and 3. But just to give you an idea, now this is through yesterday. I don't believe this has been updated for today. Over the past year, the S&P has been up 19.63%, and this portfolio would have been up 31.25%. So pretty significant outperformance. You can see that in the first part of that year, the performance between the portfolio and the S&P pretty much tracked each other. But then things changed, growth started to work, and the portfolio took off. So that is normal. That's going to happen. So we're looking back forward, and then we're looking back first, and then we'll look at actual. So this is how it would have done. But more importantly to me than just the return are the metrics that start to uncover risk. So the beta of the portfolio is 0.84. The beta of the S&P is 1.0. So what this is suggesting is that this portfolio should be about 16% less volatile up and down than the market. If you look over here, what it's saying is it captures the upside of the market when the market's going up, but it only captures about 56% of the downside when the market is going down. Remember this when I show you the actual numbers for today. Digging further into risk, these are 6 different metrics, and then the overall rank combines these metrics. It's on a scale of 1 to 100. You can see all of these are in the 90s, and our portfolio is ranked number 93 out of 100, which means it's in the top 93% of all portfolios that are tracked by this system. And it said this means strong returns relative to risk, exactly what professional investors look for. Well suited for investors who want to maximize return per unit of risk. So this is how I designed the portfolio so that we could capture the upside but mitigate some of the downside. You can't mitigate it all. Today was a very bad day in the markets, and I want to show you what the markets did and what our portfolio did. So that's coming up here. So the S&P today was down 1.01%, and the NASDAQ was down 1.5%. If we split the two, just think of it was the whole market was down 1.25%. Group 2 portfolios were down 0.32%. So that is, yes, we were down. We were down significantly less than the market. And that is what we're trying to design for. So the combined market down 1.25%. We were down 0.32%. Again, that is significant. Very, very significant. We're always going to pay attention to the market, and whether the market's going up or down is the most important thing. So let's go over to our scatter plot, if you will. You can see on the daily, we've gone back down on the volume. The on-balance volume is now a little bit negative. We're still and have been for quite some time range bound on this market. I'll show you. It's easy to see on the chart. On the weekly, we're still in an up. So that just means over the long term, the market is still in a bullish configuration. Our moving average stack, 8 is over 20, is over 50. That's a bullish configuration. Our bear market avoidance is still bullish. Our VIX has gone back up into the yellow, you can see. And this is because of Trump statements, the war is off, the war is on, the Strait of Hormuz is open, the Strait of Hormuz is closed. This is what causes all of these problems with volatility. So a couple of times we've dipped back down into the green, and then we have gone right back into the yellow. If it's empty, that's green, just so you know. So on the short term, we've got some little issues. On the longer term, it still looks okay. If I look at the S&P on a daily chart, you can see the trend is still moving higher, but today it was a bad day. And what I really don't like about today is that we closed below the 50-day moving average. Now, that's not the end of the world. Back here, we closed below the 50-day moving average and bounced right back up. But it is a warning sign. We don't want to see that 50-day close, excuse me, the market close below the 50-day. Now, the good news, that's bad news. The good news is we had more buying volume today than we had selling volume. But the on balance volume had finally come back into the green and it crossed back over into the red. So it's just sort of an up and down shaky market. On the weekly chart, we can see that we had this really strong push up and then we've been going sideways. Do you see that? Do you see that consolidation? The top of the consolidation are those red dashes, and the bottom of this consolidation are those green dashes. What that means is we're really moving sideways, and we have been for 1, 2, 3, 4. There's a month. 1, 2, 3. I would say there 4. So for 2 months, we're really going nowhere, just bouncing around up and down. And this is that uncertainty that we've been seeing in the VIX. Now, when you have a sideways market, it's either going to break out to the upside or the downside. I still believe that we're going to break out to the upside. We tried back here, which was Wednesday, to get up out of this resistance, but it failed. We'll just have to wait and see. I don't like the uncertainty in the market. I don't like what's going on in the world because of Trump's policies. But the market's trying to hang in there. And what I really do like is these portfolios that I've put together that are really about capturing the upside of both the S&P and the Nasdaq. Part of our investments the whole thing should outperform the S&P, but some of it should outperform the Nasdaq. But we want to do that while at the same time mitigating as much risk as we can. So today, which was a very bad day in the markets, I'm very pleased with how our portfolios performed relative to the markets. It's easier. Remember, if Monday turns back up, it's pretty easy to overcome 0.32. It takes a lot to overcome 1.25. So that's why mitigating some of this downside is really good. This is just one day, but it's a really good first day. So if you have questions, if you need me, shoot me an email or hop on my schedule and we'll go over your accounts and your portfolio. But I'm happy with what I'm seeing so far. Hopefully that will just continue on and on and on going forward so we can capture that upside that you want, but still being very aware of the risks inherent in our economy, in the world, and in the markets. So that's a story. Enjoy your weekend, and I will be back with you early Monday morning. Bye bye.